All right, are we ready? Okay,
Do
great.
it.
Hello and welcome to the imperative for incorporating ESG into the due diligence process. My name is Sarah Piak and I'm the marketing manager at the Martec Group. During the next half an hour, we will examine the emerging role that ESG has begun to play in due diligence, review industry research and emerging trends, and provide best practices for quantifying and benchmarking companies' ESG policies. This webinar is brought to you by the Martec Group and Goby. The Martec Group is a global market research and consulting firm headquartered in North America with offices in Chicago, Detroit, Frankfurt, Germany, and Shanghai, China. For nearly 40 years, Martec has been providing unparalleled quantitative and qualitative research to top companies worldwide. Goby is the most intelligent, comprehensive, and intuitive platform for ESG management. Their platform helps to attract and retain investors, accelerate sustainable and responsible growth, and mitigate enterprise risk. Martec and Goby have partnered to study and advance ESG solutions for private equity firms and growth strategy teams. Before we get started, a few housekeeping items. First, this webinar is being recorded. The recording and slide deck will be distributed to everyone after the session. Second, the webinar should run about 30 minutes. We'll save the last 5 to 10 minutes for questions. If you have questions during the webinar, you can submit it on the GoToWebinar control panel in the questions section. We'll try to answer as many questions as we can, but if we don't get to all of them, members of our team will follow up after the webinar to provide answers. Now that we've covered those, let's introduce today's speakers. Chuck Bean is Partner and Chief Marketing Officer for the Martec Group. He works with clients across a wide variety of sectors, ranging from building and construction, automotive, retail, fintech, and private equity. He brings more than 30 years of market research and consulting experience. Chuck leads Martec's Voice of the Customer VOC practice area, which encompasses customer experience, journey mapping, branding, behavioral segmentation, loyalty and satisfaction measurement, and qualitative data analytics. His work also includes leading Martec's newest practice area of emotion intelligence, which utilizes linguistics and psychology to develop practical solutions for understanding customers' emotions. Keely Lev is the Chief Revenue Officer and board member at Goby. She has more than 15 years of experience in investment management and ESG. As Chief Revenue Officer, she leads the sales, marketing, and customer experience team at Goby. Keely earned her bachelor's degree in architecture at the University of Illinois and her MBA in international business, management strategy, and entrepreneurship from Northwestern University, Kellogg School of Management. So with that, let's get started. Chuck, off to you.
All right, thank you, Sarah, and hello, everybody. Appreciate your time today, and really a pleasure for us to be involved in partnering with Goby on this important webinar. We think this is a critical topic for many of our clients and for all of you out there, and so we hope to help you understand why it's important, why ESG is important, to whom it should be important, which verticals, what types of organizations, and then why this is something you need to pay attention to, and talk about the growth that we see based on the research we've done and just based upon the work that we do with our ongoing clients, particularly in the private equity practice. So what I'll talk about first is why ESG, and we're really going to look at that from 4 different perspectives. The first 2 on the left side of the slide, its importance to your stakeholders and stakeholders writ large, as well as just organizational alignment and really best practices for not only your organization, but your portfolio companies, et cetera, really have to do with just best practices and good business, sound business principles. The 2 on the right are potentially even more important because they really drive to the bottom line, and that ESG is not just a feel-good topic. It's not just trendy. This is something that really has a powerful force driving value to the bottom line for you, for your stakeholders, and for your portfolio companies. And then it also is a critical piece of alleviating risk these days and minimizing liability. So we'll start with why it's important to stakeholders. So what we've seen from not only our practice, but also from the research that we've done in a variety of spaces looking at ESG and its growth, is just a continuing wave of attention from a wide variety of stakeholders. And so that as stakeholders at the limited partner level, at the general partner level, the private debt level, start to pay more attention to ESG and how it impacts businesses, the firms that have a strong knowledge and understanding of ESG are going to be at an advantage. So read as this is a way for you to get ahead, and ESG is a springboard to being leading edge, to being a thought leader. So particularly if you're dealing with any public-facing LPs, more and more if you're talking about the larger pension funds, anything that has a government backing, endowments, these are all areas where this has seen a tremendous spike in importance, and ESG is very prominent in terms of the requirements they have when providing funds. It also helps them to understand and align their investments and to communicate more clearly. So there have arisen, and this is where Goby comes in and is really strong, is many management tools out there that are turning this into much more of a professional type of area, as opposed to something that was handled predominantly via Excel and more informally. This is really a space that has grown up, particularly in the last several years in the private equity space.
Yeah, and I have to add, I mean, having been in this space my entire career, so almost 20 years now, it's even funny to look at the question, why ESG? So I feel like you spent all these years having to explain the why. Like, this is why you have to care about ESG. This is why it should be important, and you have to evangelize the whole idea of ESG, and then you have to go ahead and, you know, talk about your product or your technology, your service. Now I feel like we're finally in this era where we almost are not going to add, like our next webinar, we won't even say why ESG. We're just going to be like, of course, ESG.
Exactly. Yeah. And I think our research pointed that out very clearly in the last year or so, that more and more firms really, it's become second nature to them, as opposed to something that's a new topic. So continuing on then, the other key areas that we talked about, the second one being organizational alignment. And this is just quite simply better achieved if you have defined ESG goals. And it's still, I think, and Healy can weigh in on this as well, it's still a little bit surprising sometimes for us to hear that there aren't ESG goals in place. That's sort of the starting place. And from there, putting in place more of a centralized ESG platform. We'll talk later on about where we see this kind of becoming more pervasive and how it's filtering its way down through various levels, various types of organizations. But that organizational alignment is another critical piece of, again, just sound business practices, particularly not only for you as a holding firm or the equity firm, but the portfolio companies as well. So it really does impact the entire ecosystem, not just where the funds are being raised. And then, as I mentioned, increased value add. I think this is probably really what cements the value of ESG, and why ESG should be on everybody's to-do list, radar screen, is the importance of what it does to the bottom line. And not only in terms of your ability to raise funds at the early stages, but later on when you go to exit and you've got on your hands a more ESG mature company that you can offer to the next investor, the next firm. And so this is the wave of the future, is these funds are going to hold greater values, greater multiples, and greater ROI for those companies. So it's just a solid financial investment to invest in ESG, as well as just sound business.
And with regards to, you know, organizational alignment, I might mention too, so Goby, we've been around for the better part of 12 years and got our start predominantly within commercial real estate, both public REITs and private equity. And there wasn't necessarily this top-down or organizational alignment. A lot of properties or assets were just randomly doing things, you know, random acts of sustainability, or ESG, if you will. Some chose to report here, some did this, but no one was conducting the orchestra. So really having that plan, that vision at the firm level, and then at the fund level, and then have it kind of trickle down is really important versus a bottom-up approach. And that's something that, Chuck, you and I think have the opportunity to work with our clients to do, is to make sure that it's ingrained and in line with their DNA and the focus of their business, and that it properly trickles down, deep enough so that it has teeth and it's not just a policy and a binder at the firm, but so that it also has direction and it's not just random acts of sustainability at the portfolio company level either.
Yeah, exactly. And I think the final piece here, this risk mitigation piece, is also obviously a financial consideration. And it starts at the due diligence phase and moves onward from there in terms of avoiding any unsafe investments. And here's a comment from somebody in the space, middle market space, that they won't even write a paper if we're not already checking the boxes on all ESG. And I think Healy's going to talk later on about some of the specific risks that you can avoid and some of the things that should be on your radar screen that are ESG focused and that you can stay on top of, and again ahead of vis-a-vis the competition. And then just to kind of get into the interest levels around ESG and just where and who do we see this interest coming from? Because there might be some people who think, well, this is not something that's going to impact me very soon. And the reality is there are a lot of reasons why you might want to reconsider that perspective. One, the US is well behind the rest of the world in terms of sustainable investing initiatives. And this chart shows the US versus Europe, Canada, Japan, et cetera. And we're kind of far down the list. We're a little bit behind regionally. And so there's a lot of work, a lot of regulation, in fact, in Europe that's coming this way. We'll talk later on about the Biden administration and the anticipated changes that are going to be made there. But if you have anything that's global in nature, if you have anything that is European focused, especially, recognize that there's going to be much more of an ESG lens that they're looking through. Healy, I think you had actually come across an article recently that talked about in the emerging markets how important this was.
Yeah, for sure. So it had just mentioned if you do have portfolio companies or investments abroad in the emerging markets, they might not have the infrastructure regulation necessary that drives ESG in any way, but you as the GP are still responsible because that's your investment for what it's doing. You don't get, a get out of jail free card because it happens to be in a developing country where there, there is an SFDR and other types of regulation. And Chuck, I'd ask you your opinion on this. So we all know, no one's shocked that the highest proportion of sustainable investing is in Europe, but the trend is weird. Why do you think it's going down? That's shocking to me.
Yeah, I think the reason it's going down is there's been some leveling off in terms of the types of industries that they've been looking at. And I think it's also just a much more mature, it's gone from 60 down to 50%. And so in terms of the portfolio, we've seen these shifts over a longer period of time with Europe and other areas where it has more to do with the verticals that they're focusing on and some of the areas where it's just quite not there yet or not as necessary. But great question. I think overall it's still going to be at the high point for the regions that we're looking at. And then the other consideration is fund size. It's sort of a Goldilocks situation here. If you're one of the big guys, you've been focused on ESG for quite some time, and if you're in the middle market, what we've seen is that's where most of the dynamics are going right now, where we're seeing most of the firms embracing ESG, embracing solutions, really kind of putting on the more mature faces to how they handle ESG. But that doesn't rule out the lower middle market as well. The lower middle market folks that we speak with see the need. They just don't have the processes in place. But even there, they're saying, within the next few years, this is going to be a wave that hits our shore as well. So in general, if you have a lot of portfolio companies, if you're at a fund size north of 500 million, this absolutely should be on your radar screen. But even if you're in the 300, 400, 500 million, it's not far. You're going to have to pay attention to this based upon those drivers we talked about earlier, whether it's the type of LP or the other causes that are really forcing this to be more pervasive throughout the space.
Yeah, the Goldilocks situation is an interesting way to say it, because you do have, on the very smaller end, or like the family offices, like they might care about it altruistically, but they're not going to put capital necessarily into ESG programs. And then on the opposite end of the spectrum, like you said, we on the largest side, we see folks that actually do have even in-house ESG teams where they're not just making the investor relations person part-time wear the hat. ESG hat. They actually have full-time VP level people doing this. But I'd say on both ends, those are the exceptions and definitely not the rule. Like you said, the thick of it, the critical mass is, you know, in this we'll call it adolescence maybe, of trying to make their program from homegrown to, you know, to keep up with the LP demands.
Yep, agree. And then the other area is market focus. So everybody's aware of what's been going on, and especially the last few years in terms of current events and a lot of the societal issues, especially. Environmental issues have been around for a long time with investing. EH&S has been on people's radar screens, particularly in spaces where you have to, chemicals or building construction, et cetera. So the E of ES&G has been around a little bit longer than the S&G, but the S&G really has taken off, and it's impacting everything from B2B to B2C, IT, healthcare. You see a listing of the number of deals that have happened recently where they've had some kind of an environmental or ES&G focus, and so it's not limited to just certain verticals anymore. It's really becoming, because the societal and governance covers a wide variety of spaces, more so than the environmental perhaps. It's again becoming more pervasive in all types of deals and whatever might come across your plate. And then finally, the opportunity for growth. And I think this is probably what seals the deal in terms of, this is not just a trend. This is something that is going to continue to grow, has a long runway. What we just talked about is, you know, it's filtering its way down in terms of fund size. It's going to continue to accelerate, not just grow, but accelerate in growth. And what we see is there's going to be an increasing need because of that for outsourcing, and not only for platforms, but for consultation. I think that's another key piece of this, is a lot of firms just aren't familiar with what they need, how to do it. So the consulting piece of this is also critical, not just a software out of the box. And I think we've also seen some things like private debt companies talking about varying interest rates depending upon ESG scores. Certainly LPs are starting to provide checklists to GPs that they want filled out before they even take any additional steps. So the entire fabric is just changing in terms of becoming much more of a fundamental piece of standard operating procedures, is to have ESG at the table, and something that's talked about at a very early stage and really throughout the cycle, not just fundraising, not just due diligence, but something that really is ongoing throughout the lifetime of the ownership. Healy, I can't hear you. I'm not sure if
You're right. Sorry, I went on mute, but I am off. So thank you.
Wouldn't be a webinar without it.
Yeah, some people can read lips, but we'll not make that assumption. So all I was going to say is that it kind of highlights, you know, the partnership. Your point about finding that balance between the technology and the consulting, and it highlights the partnership between Martec and Goby, because so much of this still, you know, every firm is its own special snowflake. You need some brains and some strategy behind it. You need that consultancy, but a lot of it, especially when you get into the monitoring phase, can be scaled via technology, and you don't necessarily need the people in Excel. So if you can strike that balance and make sure that you're putting the brain power where it needs to be, but leveraging the technology where you can to scale and make sure that you're efficient and you're consistent with data collection and reporting, to me, that's the sweet spot, and that's what's exciting to me about this partnership. So
yeah, absolutely. And then the other piece, you know, beyond just the sound financial sense that this makes, is there's going to be a regulatory backbone to this that is intensifying with the new administration. There's quite a bit of discussion around adopting similar regulations to what's already in place in EU. Healy mentioned some of that earlier. And then just, you know, the fundraising machine is not going to take its eye off of this. And so you're just going to continue to see GPs who have an enhanced story to tell around ESG ahead of time are going to be in a better position with those LPs. They're going to be able to show that they're serious about ESG, that they've adopted best practices, and again, the ROI is there for them based upon that. So with that, I'll turn it over to Healy, and she'll talk about ESG data and the due diligence process in a little bit more detail.
yeah, absolutely. Thank you. And of course, feel free to interject at any time.
Mm-hmm.
Let's see if I have control. All right, so if we look at just the general PE life cycle, so fundraising is just going to be an underlying concept that's just perpetually happening or on the horizon or just finishing. And it kind of overlays as you're looking at new deals and going into diligence. And we actually think that's the perfect time to be looking at ESG. So the whole purpose of due diligence, of course, is to identify and mitigate risks up front. ESG can be a risk, right? Especially if it's material to the supply chain of a business, or if there are things that are going to that have legal implications. So best to suss them out up front when you're sussing out, other things that might be material to the business. That's maybe, the negative side or the, the concerning side is the risk mitigation. On the flip side, ESG can be a big value add. So when you go to exit the investment or the deal, there are ESG implications that can make it more valuable as you go to exit. So you want to be thinking about ESG at all points in time during the PE life cycle, because there are implications. When you get into that operating phase, and this is where I mentioned finding that perfect blend of consultancy and software. So at the due diligence phase, you're going to want consulting, right? You're going to want a human brain to dig in and figure out in all facets of the investment what they're doing, if what they're doing is right, if what they're doing poses some risk. And then you want to continue to monitor the investment during the time that during your holds period, right? That's the time to leverage the technology, because it's going to be a series of surveys, survey administration, communication, data collection, data leveling, making sure keeping tabs with new LP demands or any emerging frameworks, and being able to consistently and accurately and scalably report. And then upon exit, of course, you hope that, of course, the entire investment has increased in value, but specifically with regards to the ESG components. And I was recently listening to another webinar where it was an ESG finding or implication during due diligence that actually made them walk away from the deal, because it had implications. I can't remember if it was like a child labor scenario or otherwise, but it just had too much liability for them to continue, with the investment. Had they not had an ESG component in their due diligence framework, they might have missed it.
And I'd say the other kind of mechanical piece that's why due diligence is a great portal for this. Selfishly, we heard from some of our clients is that because starting to take bites and get into the ESG management world, you can do it in due diligence as part of the deal without incurring access to the management fees. So you're actually the funding mechanism for ESG tied to the due diligence phase. It makes it a little bit easier for funds to start getting into it more formally and really adopt some of those best practices.
Yeah, there's definitely a push and pull as to who foots the bill. So if it can be, fronted during the time of due diligence when there is the money kind of flying around, for lack of a better way to say it, versus coming out of a management fee or out of an NOI, it can be appealing. And I also think it helps just introduce the concept at the time you're doing a deal, right? This is a new relationship. This is a new engagement. You're letting them know as a GP, this is something you care about. It's something you're going to be paying attention to. It's something you're going to be holding them accountable for during the hold period. So best to know these things out of the gate, right? As you guys are kind of kicking off the relationship.
Mm-hmm.
All right, so as mentioned, we want to understand the value, the positives of ESG actions and programs, so not just, from a risk standpoint. And we want to, I think at the end of the day, investors want to do the right thing, right? They want to make sound and ethical investment decisions. Nobody intentionally wants to make a bad investment decision. And of course, as we mentioned before, that's going to be, it's reflective upon the firm, right? And it's great. You can have a firm-wide, firm-level policy that's sound and valuable. And I think that has been the trend up until this point. But the increased demand is for some tentacles down into the investments, for some accountability down into the actual operations of the companies you're investing in. And as we kind of said before, no get out of jail free cards, right? You're responsible for, from the firm level all the way down to the portfolio company level, and you're responsible for the whole life cycle from inception to exit. So what are some of the topic examples? I do get this question a lot, because you might say something very broad like social, like the S is for social. So people want to know what specifically, is within each of those categories. So the environmental factors that we're going to look at, things like pollution, exposure to extreme weather, carbon management, climate risk, of course, energy, water, waste, resources, supply chain. So everything to do with, a portfolio company's environmental footprint. And this can be a tenuous or a very detailed piece of data to collect. So there are some strategies when working with the portfolio companies on how best to collect this type of information without being too intimidating or too invasive too quickly. How do you stage it in? Year one, if you come out of the gate demanding all this types of information versus kind of staging it and being in line again with the goals of the firm and what's material to the business and what's important to the stakeholders. In the social category, human rights, safety, worker safety, product safety, customer data protection, diversity and inclusion, which of course is a topic that's become front and center, in my opinion, more so in the last 18 months with even the NASDAQ announcement of, needing 1 female and 1 minority board member in the next couple of years. And I love that with that, it can't be the same person. So you can't get double diversity for a female minority. You have to be 2 separate people. And then within governance, this is one that it has its own piece, right? But that in talking with our end users, it's almost like table stakes. Like you don't want a GP or fund manager that doesn't have sound governance policies, that doesn't have these types of checks and balances in place. So that one is the one that feels almost like it should be a given. But again, you need to have sound policy around it and a way to capture it, not just at the firm-wide level, but down to the investment level.
And I would just quickly add, Healy, I think the other point is some of those factors go well beyond due diligence. So diversity is something that also affects you as an organization as well. And we know that a lot of firms are looking at diversity in hiring, and in the private equity space that has been traditionally somewhat challenging. There are firms that specialize in that. So a lot of these go well beyond just the due diligence phase in terms of their impact.
Yeah, and to your point, if you're beginning at the start of the journey with the due diligence phase, so say that's when you draw your line in the sand. So on something like diversity, you have a percentage of diversity in management, you might have a percentage of diversity in the entire firm. And then every year, every quarter, every semester, whatever cadence you decide is appropriate, you measure an improvement, right? And the idea, of course, is to show continuous improvement, as with all other things up and to the right. But yes, to your point, you want to draw that line in the sand, and diligence is the natural place to do that. So some best practices, having a formal policy in place is important. It's okay if they don't have one, as long as you are giving them the tools and access to the resources so that they can create one. Collaborating on ESG materiality is super important. So whenever we start off an engagement with a new client, we want to make sure that either they've gone through an ESG materiality assessment or we will perform one for them. It really provides the roadmap of like, why are you doing this in the first place? Is it simply a check the box exercise for you? What types of things should you focus on? Which frameworks should you subscribe to? And we're plotting on an axis what is important to the stakeholders and what is material to the business. And then once you have that kind of DNA or you've completed the soul searching exercise, you actually make a plan quarter by quarter. Okay, here's our tactical execution and implementation plan over the next 36 months. So it becomes attainable, right? I think sometimes ESG is just intimidating. People are like, I don't know where to start, how to start, what to do, which frameworks. But once you see the results of one of these assessments, it becomes very actionable. You kind of see step by step, quarter by quarter, exactly what you're going to do, and then you can see at the end of it, how much real progress, measurable progress that you've made. Climate risk is huge. I don't think I need to harp on that with this crowd. It's real, it's happening, and it's on us to correct it. And then, yeah, just certainly thinking about beware the clock. This ESG train is leaving the station with or without you. So we were talking on our pre-call, if you hate change or you're a naysayer, you'll hate even more so being irrelevant. I think that the time has passed where people think that this is something that they can deny or ignore, hoping it'll kind of go away. Though I think there's still some work to be done on convincing some folks that there are direct financial implications of sound ESG or causation versus correlation. But that's our job, I suppose, being in the industry to prove out. So as mentioned, in our partnership with Martec, if you think about the strategic consultancy as well as the technology, so Goby, we provide the technology piece, and it comes heavy into the phase. It starts at diligence, but then certainly happens within the monitoring phase, so within the hold period. And what you're really trying to get at, if you're looking at company B here, the purple line is a target for a salary, say, is like positive trends, right? So company B is improving, they've exceeded the average, they're trending in the right direction. Company C feels a little bit stagnant. Now, what you want to do about this, that's a whole other thing. If you're just monitoring, communicating it, that's one thing. We can actually give access for company B into their own data so that they can see how they're doing and improve. And it all rolls up, of course, into a view that will, you can report with regards to the fund, with regards to a fund vintage, with regards to a certain sector like consumer goods, with regards to the entire firm. So once you've figured out the mechanism for communicating and repeating a survey, then it's just a matter of data presentation and data completeness. And that's really the name of the game. Similarly here, so like I said, when we intake this data, the goal is 100% participation. This is not an optional thing. We want all the portfolio companies to participate. We're going to make sure to curate a set of questions that touch upon the E, the S, the G, and are in line with the sector. You could do different surveys for different sectors. You can align with different frameworks like UN, PRI, SASB, or otherwise. And then you want the ability, again, to just kind of slice and dice. You want to look at individual portfolio companies. So company M is getting an A grade, which is green, high level of performance. Some of the others look like they're getting a B grade. They're kind of yellow. And like I said, you can observe any which way once you have the data collected. And then the other thing people often ask is, okay, great, so what do I do with it? Now what? Great, we have this data, or we've observed a trend, what do we do? So we try to put out these heat maps as well of focus areas. So you could see, green being good, yellow being not as good, what's trending in the right direction versus, what might need some focus. So just at a glance here, I can see in the environmental category, need a focus on carbon footprint. It's kind of just been stagnating there at a, an average to lower level. Versus on the right-hand side within social, internal communications has trended up, in the right direction, and that kind of thing. And of course, it becomes more pronounced with the more data that you have, the longer that you've been collecting the data, etc. So also try to provide actual focus areas and insights where people can know where to put the attention.
And then this obviously is what good looks like then as you add to the portfolio and through that due diligence process, making sure the companies align with how you're performing and where you're trying to be from an ESG profile standpoint.
For sure. Yeah, and there's kind of two dynamics you want to continue to accommodate for. It's new deals coming into the fund, and then it's also just the changing and evolving landscape, right, of what the LP demand is. And then of course, at what point are you tracking just qualitative or subjective kind of concepts versus when you actually start to track quantitative metrics-based data. And then above and beyond that, there's a notion of verification. So you could say one of our questions is, do you have an environmental policy in place? So I could say, yep, sure do, and you could take it for face value. Or you could say, upload it here. And then you might have a check and balance on the other side of someone that reads it, and then they might assess the quality of it. So there are varying levels that you can, have with regards to how do you address this. And I think that it depends where you're at in the journey when you start and where you're trying to get. And to me, it's about phasing it in, because if it's too much too fast, you're not going to get the adoption that you need, to drive a successful program. Okay, I think 4 minutes passed, but we'll try to keep to time. So let's definitely take all the questions that we can.
Yes, that's great. Thank you both. We do have a few questions. So for those of you hanging in there with us, thank you very much. Healy, this might be a good question for you. So what metrics do you recommend we start with?
Yeah, it's a good question. So it depends. So the worst answer that no one wants to hear, but does depend on, how many portfolio companies do you have, what industry and what sector, what are your goals? Have you been through materiality assessment? What are you trying to do? But so it kind of does depend. So depending on where you're coming at it from and what sector, we kind of have a prescribed set of both qualitative and quantitative kind kind of facets that you want to look at. So not to dodge the question at all, but send me an email separately with a bit more detail on what the makeup is of the fund that you're looking at, or of the firm, or of the thesis, and I will answer the question very directly for you.
Perfect. And on that note, can we advance to the next slide so we have our contact info? Perfect. Thank you. All right. Second question. What are the most common ESG related showstoppers in the due diligence process? Chuck, you want to kick that one off?
Yeah, I'd say it is still probably a baseline of the environmental issues more often than not. But I think we're seeing more and more of diversity. We're seeing more and more safety, whether it's worker safety, rising to the surface. So I think more of these social aspects are becoming deal stoppers. I think Healy mentioned one early on in the webinar. And so, the environmental is going to be here for a while. That's not going anywhere. And if anything, it's intensifying. So that's a rising tide. But where we're seeing more growth is the S and the G components. And I'd say particularly the S is where, from a deal breaker showstopper standpoint, we're seeing more of those bullets that Healy outlined earlier on.
DE&I, absolutely.
Yeah.
Another question, how do general partners and companies prepare for adding ESG to the due diligence process, and how long should this take?
It's a good question. So with regards to the how long, it can be, we could be up and running in 6 to 8 weeks, depending on what it is you're trying to do. You want to develop an appropriate set of questions, for your due diligence questionnaire with regards to ESG. You want to make sure that it's in line with the goals and what you're trying to do. And then you want to make sure that it's communicated well as to why you're doing it, what the expectations are for filling it out. And of course, it has to be in line with, the deal itself and the kind of concurrently with that process. So it can be quick if it needs to be, especially if you're working from one of the prescribed templates and you're not customizing it too much. And some customization is to be expected. So we recently worked with a company that makes investments in software companies, and they wanted to beef up the section on cybersecurity. Totally makes sense. So those kind of tweaks can be made. So yeah, can happen fairly quickly. And with a solid and sound communication plan, can also be quite effective.
And I would just add, it's generally very quick once you've done it a few times, right? So it's the old, it depends again. If it's your first time, it might take a little bit longer, but if you're seasoned at this, if you've made your way down the road a little bit with the platform and what you need to measure, it fits into the same timeframes that due diligence does in general, which tends to be weeks and days, not months.
Perfect. All right, so this one is about commercial real estate. So Healy, this might be good for you. We invest in commercial real estate. It seems difficult to conceptualize how to apply ESG policy and management outside of environmental, and they hire outside managers. Any suggestions on how to start?
Yeah, for sure. So as mentioned before with commercial real estate, they were early adopters of ESG, but like you said, very, very heavy on the E. So you have real assets, they use energy, they use water, they have waste. You can, whether it's a strip mall or an apartment building, there's still KPIs there, right? There's still a physical asset. And it's all, kind of matured. Now, what we're seeing real estate companies is saying, great, we've gotten really good at the E. We have these formal frameworks. We know exactly where we're reporting. The LPs know what to ask. The GPs know where to report. It's all very civilized. But what they are saying now is, okay, but we do need to look more at the S and the G. We've been so heavily focused on the E that we have not expanded outside of that. So that is a trend that we're seeing, where you have these real estate companies that might have had sound operational practices for years, going back to do a materiality assessment because they're saying, you know what, we need to holistically be looking at not just the E. And then yes, it does get squirrely, of course, with third-party operators because, of course, they have some control over the property. It depends on, the structure, and some of the third-party managers might have their own programs or, how they're going to apply ESG. So it's something that we can work through. We are used to all different types of scenarios when it comes to, ownership and operator relationships and the reach and where someone starts and where someone stops and how to empower, the ownership. So again, happy to talk through a specific use case, but just know that if you're a real estate operator and you've been heavy on the E for the better part of a decade and are wondering how to expand that out to the S and G, you're very much not alone. And that's where we're seeing, that sector at right now.
Yeah, absolutely. So really collaborating on that checklist, and I'd imagine like succession planning would be an important G factor in there as well. Next question is, for smaller funds less than 300 million that don't yet use ESG software, nor have an ESG policy, what do LPs want to see from you when fundraising, specific targets, or just a general policy? Chuck, you want to start?
Yeah, from my standpoint, it's both. I think that the LPs are asking for the same types of metrics, the same types of, the checklist doesn't change just because the fund size is slightly smaller. And so you have to be prepared to present both. And again, I think the more competitive it gets, and we've seen that spike, particularly in the last 12 to 18 months, is the deals it's increasingly competitive out there. And so the difference between your ability to get that fund to participate and to win the deal starts with being ahead on these kinds of topics. ESG is one way to do that. So you have to focus on both. Can't look at it like we're small and we can wait. You need to be on top of it now.
Yeah, it depends on the type of investors you're trying to attract to, right? It's not the fund size. So I think for years people knew that European LPs are going to be demanding this stuff, and their questionnaires are going to be more sophisticated and aggressive. Well, now that's domestically as well. So yeah, there's no skirting it for sure.
So okay, so just to reiterate, definitely have a general policy and then kind of collaborate depending on your space about those specific targets. And then we have
specific targets, that's exactly where Goby can help you with benchmarking, and you don't have to start on your own. That's where I think the value comes in of leaning on people, the professionals who do this all the time.
Absolutely. All right, we have 2 questions that we'll get to, and then the rest we may follow up. So in cases where the company doesn't currently collect data for quantitative metrics, should the question be asked anyway, and how to avoid penalizing a company for something they are not doing, but rather to encourage them to start tracking this data and making the measurements.
Yeah, so, I think it comes along the lines of, there's communication around this, right? You're not just blindly blasting out surveys. Like, you want to socialize and explain like why you're doing this, why it's important. And then I think part of it, especially out of the gate, is explaining that like it's not meant to be punitive. It's really not. Like, especially that first year that you're collecting the data, we're all just trying to draw a line in the sand, right? And just figure out where are we at today. There might be some benchmarking, sure, within consumer goods or within your peers in the sector, but I think it's all in the good spirit of like, let's see where we're at and let's improve, not to be punitive of where you're starting. If I think to the future, again, having seen this play out to maturity within real estate, what does ultimately end up happening is there are frameworks that emerge as the dominant frameworks that everyone kind of knows where to report, and then you get ranked. So the way that works now is within your sector, you are ranked amongst your peers based on your scores, both qualitative and quantitative, and people get very competitive for those ranks. So I could see this also ending up in that way, but that's just not where we're at now. So again, just explain why you're doing it, why it's important, that it's not a punitive scenario, that we're just trying to draw a line in the sand and improve, that we're going to help provide the best practices of how to improve. So yeah, those are just my thoughts. I don't know, Chuck.
Yeah, I mean, I think operational fitness won, and we're all going to make more money too. So that's the value here, is that, as you said, that not only on what we've talked about with the deal and exiting and the return, the ROI, but also our ability to get debt at better rates. All of these things are going to be driven by some of those scorecards that you're mentioning that are going to become de facto measuring sticks in our space. So we've got to stay competitive. This is going to be a key measuring stick for being competitive.
Perfect. All right, so we'll take one more question and then the rest will follow up. This question is, I manage diligence for tech-focused funds. we are looking at responsible use of artificial intelligence as a social issue. Thinking in this space seems to be nascent. Any good frameworks that you can recommend?
That's a tough one for me, Healy. That's a great question. Yeah, that's advanced stuff. I think that's great that's being looked at. I personally have not had a lot of experience with frameworks that are tied to AI specifically. I don't know if you guys have yet, Healy, but I think that fits perfectly under the social aspect as well as the governance aspect of what you're doing.
Yeah, I don't know. My mind goes to science fiction movies, and where the robots take over the world and where too much is too much. But no, offhand, I don't know of any frameworks. I'm happy to confer with people within my firm that are much smarter than I am, and get back to whomever that is if you want to shoot.
Yeah, same. Willing to cast a net, see what we find. Yep.
Well, we're coming up close to 3 o'clock Eastern, so we appreciate everyone that has stayed on with us. And thank you all very much. Our contact information is below, and the Martec Group and Goby, thank you very much.
Thank you.
Thanks, Chuck.
Thank you, Healy. Yep. Bye-bye.
Bye.